Investors and traders, welcome to the channel. Today is 21st of September 2024. I hope everyone is having a great weekend. We will be taking a look at the key US markets in this video. Mainly, we'll be focusing on the interest rate markets through the eyes of the treasury notes and bonds. And then we'll take a look at the US dollar, a little bit on the gold market and the silver market, and a little bit a touch of forex, such as the Japanese yen versus the US dollar, euro versus the US dollar, and the Great British pound versus the US dollar, and then more detailed analysis of the actual stock indices for the US market in a follow-up video Sunday, and then we'll also try to take a look at some of the sectors as well. As always, this video is for educational purposes only. It is not a financial advice. So let's start by taking a look at our timing model. This model has done a pretty good job at calling key turns in the market. And recently, the 3rd of September was 29th August to 3rd of September was we were watching, and 3rd of September we saw a fair amount of volatility come into the marketplace. Now I'm getting some further timing around 7th of October and 14th of October, and then there's a real key one is coming around the 7th of November. So I think the 7th of November one is pretty important. These two might be more of minor timings, and I'm also working on longer term cycles, so probably try to get further timing cycles for you guys. And just a review of what we were watching on the Nikkei index. We were getting a timing on the 19th of September, and this is a day after the Federal Reserve's announcement, and we saw a pretty good day coming into the stock indices in the US, and the Nikkei was up as well. So let's start by taking a look at the dollar index, and let's see how the dollar did for the week and for the day. So on the daily chart, what we can see is the dollar is just basically range bound. So we are not seeing much price action, but where it is at the moment, and let me actually show it to you on the weekly chart. Here we go. It has come all the way right into this um, gap formation, which we had identified here for weeks in advance, months in advance. And 107 is a key resistance level for the dollar, but look, it's just been moving lower since April. So in my opinion, it's also the case that it appears to be oversold, and also it is right at this key support, which is the 61.8% retracement, this 99 level. So it's bound to have some sort of support coming from the structure and this key level. What it could also do is it can go and basically try to test the lows of 99 or the lows of 24th of July week. That's also possible. But it means that maybe we might actually see some sort of strength coming in this in the dollar index, because the way it closed last Friday, you can see there was some strength coming into this market. It's not a close where the market is closing at its lows. There was fair amount of it was just in the end trading range week for the dollar index, and it was also a very key week where the FOMC meeting and jobless claims came out. So a lot of economic data there as well. And then we have this line here. I like to call it the ladle line. It's also providing support here. So there are a number of things. The key thing is for the US dollar that if it breaks below, and it needs to be on closing basis, ideally I would like to see two consecutive weeks where it closed below the 99 level, and that would actually mean the US dollar could actually move much lower and do it rather quickly, and then it can go and actually touch the lows of 4th of January 2021. That possibility is there. Now, one of the reasons that why the US dollar had been pretty strong, so you can see that this is where the inflation was actually kicking up, but the US dollar was actually also moving higher. And one of the fundamental reasons for this is that when you have a situation where you have the monetary policy which is tight, meaning that the interest rates are moving higher or they're already high, and on the flip side you also have the fiscal policy meaning taxes and or spending, which is loose, so a fair amount of spending happening, then the value of the currency is bound to move higher. And this is what we have seen in the US dollar when the Fed started its interest rate hiking cycle, because other central banks also started to do their hiking cycle as well. But in the US, there was also quite a lot of spending happening from the Treasury, so Janet Yellen doing a lot of spending, and that just made the currency really attractive. And what it also did is that it also exported a lot of inflation out of the US and into the rest of the world, because of the dollar being pretty strong and majority of the trade is conducted in the US dollar denomination. Now, with the interest rate paradigm actually changing, we are likely to see the lower dollar. However, because of the technical levels, it might not just happen straight away. Longer term, this is something I have shown in the past. For the new subscriber, this is a really long term chart. It's a monthly chart. It says index quarterly, but I changed it to on a monthly basis, and it's got a time symmetry. You can see that it took about 10 years in the early 90s to somewhere around March of 2002 for the market to form a peak. And then it took all the way from 2002 to 2007 when the dollar actually lost a lot of its value. So it did that in about 5 to 6 years time period. And then the bull market in the US dollar started in earnest somewhere in 2011. And what we have seen a top which came in 2022. It also took about 12 years, so there is symmetry in time, and then of course there is symmetry in price as well, because if you look at the magnitudes are the same. This leads to my belief that the US dollar might have topped longer term. However, it doesn't mean that the market cannot actually go and test these highs, or maybe even make a slightly higher high, because the 78.6% is a little bit higher. If you look at this part, you can see that the market had a sell off, then it made a new high, and then it came back and it tested pretty much the highs again, but unable to do that. That's when the big decline started. So that's why the 61.8% is the 61.8% retracement of the CD leg is really important, because moving below that, we could be actually looking at ABCD to the downside, so a much weaker dollar. But it's kind of hanging in right now, and all of this, what we have seen thus far, has actually been a trading range behavior of the lows of July since 2023. So on the flip side, let's actually start by taking a look at the British pound. A quick look at the British pound. So the British pound did something really interesting, because what it has done is it found support right from the 38.2% retracement, and as the dollar actually weakens against a basket of currencies, this is one of the stronger currencies against the US dollar. So we do have a target where we can see this market actually move higher to about 134. That will be roughly about, let me actually do the 1.618 expansion, so a little bit above 134 23 is what we're looking at. This is where this market is actually likely to target. It's already there at 1.272. This could lead to a little bit of a pullback, but then move higher. In fact, if we were to just take a look at this on a 15-minute chart on intraday basis, the market was doing something pretty interesting. It almost did a ABCD. Here we go. It came pretty close to it, and I believe if we just take the lows, this is the significant low. Here we go. There we go. So it actually touched the 38.2% retracement of these lows, and off it went. I know this because I was watching for this. I was looking to be a buyer for an intraday trade, but I had my entry a little bit lower at the ABCD, so I just missed it by 3 or 4 pips. It was pretty annoying, but it is what it is. And now let's take a look at the Euro USD. This is the largest currency pair. This was the um, I don't know how many trillions of it are traded every single day, followed by the Japanese yen versus the US dollar, and the Great British Pound is the third largest currency pair traded in the world in terms of the volume. So you can see this one is more muted compared to the British pound. There is still a chance it can go a little bit higher into this um, gap formation here, where it has pretty strong resistance. And of course, the most important one for us to watch is the Japanese yen. And here we can see that this pattern formation that we have drawn, it seems to be moving in that, and the dollar is getting stronger against the Japanese yen, and the chances are it might go and tag the swing highs from the 2nd of September. It's already above the 38.2% retracement. So I think that's a sign of strength for this currency pair. Now let's take a look at the gold market. Gold had been pretty strong last week, and we can see that it's just broken above this trend, this channel formation. So that is good. And if we just move to the weekly chart, we can see pretty strong looking bars. It is also above the 1.618 extension of this swing that we were looking at. So it looks like the what the gold is doing is gold is actually moving towards this target of this 2700. It's not that far away from it. It's about $50, which is not much for the US dollar. And once it gets into the 2700 to 2720 level, we have a fair amount of resistance there. Actually, those are our targets because of the completion of these big ABCDs here. But there's also a psychological level of $3,000. Maybe the market wants to also touch 3,000, but it looks pretty strong. And intraday, whenever there have been some pullbacks, they always got bought. And we are seeing a pretty strong market in the gold, but it's also reaching these really key levels. Is very close to them. It's just 2700. It's just about $50 away. So we'll be watching on daily chart any sort of pullbacks if they were to happen. Now, if we take a look at the silver chart, silver is not as strong as gold. One thing that I would like to point out is the gold and the silver. We are looking at the futures. This is COMEX gold and COMEX silver. These are not the spot markets. So if you're watching spot markets, your price levels are going to be a little bit different, but the patterns are pretty much the same. And if you prefer, I can actually switch to the spot markets as well, or also have them included in our analysis. I just include the futures market because there is a fair amount of trading which actually takes place on the centralized markets than on the spot market. So here I believe we are actually in this ABCD, which could actually see the top of this range. The only thing is that there is a 78.6% retracement from here, from this top right here. And this one has acted as a stronger resistance because we have seen one, two, and then a third day on the 18th, when the Fed day, the market actually pulled back and then do a recovery. So it needs to clear that, and then I think we are looking at test of these highs, and then possibly as high as 33.80 to 35 is the kind of where the market can go if it's able to clear these highs of May 2024. Now, let's move on to the interest rate market. So let's take a look at the what the yields were on the 2-year Treasury note. You can see that this market reached and breached our target to the downside of a yield of 3.9%, and it is kind of hovering around here. Just potential support coming in from 24th of March. So the yields are likely to rise a little bit just because of this support from a technical perspective. Uh, but one thing is that the Fed, in my opinion, actually likes to follow what the two-year Treasury note is doing, and what it is telling us, the Fed rates are, even after the 50 basis point cut, they are, I think, around 4.75%, and this is at 3.59 or 3.6%. So it is still lower compared to what the where the Fed fund rates are. In fact, we can have the Fed fund rates here. So let me type Fed funds. Here we go. What did it do? Okay, I did not plot it for some reason. Okay, same percentage scale. Okay, for some reason it's not working for me. I will have to figure out why it's not doing that. But anyway, what I wanted to show was that the market is telling us there is likelihood of another quite easily a 50 basis point cut from Fed by the end of this year, and a little bit more. So it could happen 25-25. It could be a one go 50, another 25. So which means that a 75 basis cut. This is what the market is foretelling us actually. And on the 10-year, let's take a look at the TNX. Here we go. So the TNX, you can see the yields have increased a little bit, and this is more easily seen on the futures market. Here we go. So on the futures market, 10-year Treasury note, this big ABCD completed. I still believe that actually we are heading higher, meaning lower yields. But what we have seen is actually the market pulled back for 1, 2, 3, 4 consecutive days, and this is what we had seen previous time as well. This is when the markets found a bottom in the stock market, 5th of August, 1, 2, 3, 4, about 4 days. I don't think we'll reach will match the price symmetry, but we are matching the time symmetry. So this is where the market is getting stronger. So I believe from here we'll have more of a trading range to this market getting moving to the upside, meaning lower yields. But it might just take a little bit more time. And of course, a key event took place last Wednesday with Fed, where they have actually reversed their policy, which they have been carrying on for close to 2 years. So this means that the market is likely to adjust over some time, and we are, I mean, the market, the notes market, and the 10-year, 30-year bond market intraday last Friday, where we had also the quad witching. It was very volatile. It was really volatile, and I think on the intraday basis, let me actually get a 20-minute chart up. I do recall seeing a ABCD formed. Here we go. So if we were to take just this and bring it like this, so you can see a perfect ABCD was formed, and that also happened to be the low along here, so it was double bottom as well. And then the market, you can see these are 20-minute bars. This just shot up. So this is what I'm trying to show, that this these patterns, these price projections, which we like to call ABCD, they work on all time frames, intraday, daily, weekly, monthly. We have seen several examples of this. We have also seen examples of this in real time, in the sense that we forecasted certain levels in advance and the market actually went there, such as the NASDAQ 100 futures. We have the big ABCD completed. We saw this in Google, many other instruments. So this is the really key pattern. ABCD is a seed pattern in my opinion, and I will be doing some educational videos, and I'll try to elaborate on that, what I mean by this, and I think things will become more clear for the subscribers how we use the methodology around here. So let's do the now let's go back here. So I think I'm gonna leave it for now, but I will just delete it if these symmetry lines, if we don't see any follow through next week in terms of downward momentum. Now let's take a look at the long bond futures. So long bond futures, something similar. And what happened here is just an inside day. In terms of time symmetry, we are matching pretty much what we saw the down move here. So 1, 2, 3, 4, 5. Well, it had one more move here. And we have had 1, 2, 3, 4. So in terms of time, I think we are getting pretty close towards the end of this move. The market just needs to begin to close bullish on a daily basis. And here I don't think we'll reach the price symmetry, but time symmetry might just give us the Q. Now let's also take this one from an intraday perspective, and just like the 10-year Treasury, these interest rate instruments, they pretty much move in tandem. So let me actually show you the ABCD, which also existed in this market. Here we go. The time was a little bit different. I think the notes actually formed the ABCD a little earlier than the 30-year long bond futures. There you go. It actually went a little bit lower, but then this is where it reversed, and we had the 10-year Treasury notes were much stronger. This one not so much. So these patterns actually work in all time frames. So let's also take a look at the TLT, which is the ETF with 20 plus year duration bonds. So you can see something similar. The 10-year and the 30-year long bond futures. Here the market, I think it's trying to form some sort of a bottom around here. We need bullish closes for getting the confirmation, and I believe this one was 50%. Yep, this is what it is, and this is 38.2% just visually from this low right here. There you go. So we have a strong confluence of two ratios coming together. So in my opinion, it's pretty important price level where the market is closing last Friday. We have had 1, 2, 3, and a fourth day in this down move here. I think previously we have seen 1, 2, 3, 4, 5, 6, 7 days. So here we have seen one, so maybe about 3 more days in terms of time. But I think where the market is right here, and if the 10-year and 30-year long bond futures start to move to the upside, we will begin to see yields move lower. Now, one thing is that because these markets have already moved a fair amount to the upside, or yields have fallen, in other words, and now I don't think there is too much upside left. And we have already talked about the 38.2% retracement levels being pretty close to long bond futures, and then ABCD here for TLT as well. So I don't think there is like a lot of upside, but there is still some upside, which means yields to fall lower, and then it will all depend upon the kind of data that will come out with regards to inflation. And the Fed seems to be kind of, between two things now. They're paying too much, a lot of close attention to the unemployment figures, and I think this is what triggered them to actually do a bigger rate cut rather than quarter points. The Bank of England, when they started, they did quarter points. ECB did quarter points. Fed starts with a 50 basis point cut, which is quite large for a first cut. And I think one of the, if you watch the Jay Powell's Fed chairman's questions and answer session, um, I think he's quite concerned about the revisions of the jobless claims that come in, because I think there was a revision of about 800,000 jobs, which is close to a million, a really big number. So I think they are going. He mentioned that they are going to do a mental adjustment. So I think they're gonna, whatever figures which come from non-farm payroll or these ADP, these, especially non-farm, I think they'll actually reduce them by a certain percentage, so they'll do a haircut to it, meaning that I think they've figured out there is a pattern that the actual numbers are lower. So after some time, a few months, the number actually get revised, and it gets revised to the downside, meaning actually less jobs were created, and this information is really crucial for their decision making. So I think they're gonna apply some of their own logic to it. So this is what the Fed will actually paying a lot more attention to. So this is what I wanted to talk about in this video. We have a really key and historic week which went past us in the markets last week, with the chairman of Federal Reserve embarking on a new paradigm, which is of lower rates, and I believe they're having to do that because they see that the economy, although clearly mentioned, is doing good. But then the question becomes, why are they doing the rate cut? So I think some signs they are seeing, especially with the joblessness increasing or the unemployment rates creeping higher, where they want to have easing in the system to actually alleviate some that sort of a case where actually the unemployment rates begins to shoot up, because all these things they do with the interest rates, they take some time, 3 months, maybe even 6 months, to begin to play out in the real economy. So I think the policy, if they start now, which they could have done in July, it will be actually signs in next year that we begin to see what is likely to happen. So again, there we go. So thank you very much for watching the video. If you like our video and you found it of educational value, give it a thumbs up. If you like our technical analysis using the pattern formations and the Fibonacci retracements and projections, then please do subscribe to the channel and have a great weekend, and I will speak to you guys soon with videos coming out tomorrow, i.e. Sunday. Have a great evening, day, night, wherever you are, and speak to you guys tomorrow.